Good afternoon. Catherine, thank you very much for that warm introduction, and we are all thrilled to be here to talk about the world of private credit. So buckle up, we're ready. I'm Duane Green, and I'm responsible for the Americas region of Aviva Investors, which includes North, Central, and South America. And I'm delighted to be moderating a session at the Toronto Global Forum on a topic that sits at the heart of every economy. It's credit, capital, and confidence. And as we know, credit is the fuel of growth, capital is its foundation, and confidence is what keeps it moving. And today, all three are going to be tested by our panelists. Multiple factors are shaping how institutions operate and how investors are allocating capital today. We're joined by two exceptional leaders to help unpack what's happening across the credit landscape, Joseph Pinto and Kevin Sherlock. So what I want to do at the very beginning is just set the stage or set the scene for everyone in the room, in case you're not from the finance industry and you're not totally familiar with what private credit or private debt is, or why do we use that term interchangeably. And so maybe to start it off, I'm just wondering, Joseph, just level set with the audience. You know, what is private credit? Why is it important? And what are the different types?
Thank you. Glad to be with all of you today. So I'm the CEO of M&G Investment, UK-based. We manage $400 billion of assets, US dollars, of which probably $30 billion in private credit. So to your question, indeed, there's a large spectrum of strategies, products in private credit, from leverage loan, leverage finance, to direct lending, or to asset-backed finance as well. So if I just want to give you a couple of examples, direct lending is here to support mid-market companies, mid-sized company that wants to grow. And instead of going to banks, they will come to asset managers or long-term investors to provide them the means for that growth. Asset-backed finance is a bit different. It's collateralized by any kind of assets. It could be leasing, auto equipment, anything. And basically what it brings is more, liquidity or, working capital that companies can eventually use. So different kinds of needs that are here to support the economy and actually sometimes replace banks or partner with banks or complement what banks want to do, as banks are under strong capital requirements and they cannot finance the whole economy on their own.
Perfect. And I think a lot of the undercurrent of a lot of the conversations is infrastructure investing, and how important it is to move our economy forward. And a lot of that is going to be on the back of private credit. Kevin, maybe what is the current state of the private credit market right now? How would you describe it to everyone?
So when we think about, I think your comments are spot on in terms of, sometimes we compete, sometimes we partner, and a lot of times we work together and collaborate with solutions that have a hybrid of both traditional institutional distribution for credit and private credit. I think the private credit market and the traditional lending market are in equilibrium. I think the comment is spectacular around there are more opportunities for capital raising for corporates, sponsors, developers across all the markets to figure out where they want to raise the money. And so there's a bunch of transactions, like you said, in the middle market where the terms that are offered by private credit from people who want to own the asset are more aggressive than what banks are typically allowed to do. Same thing in leverage finance. There's still a lot of regulatory scrutiny around some of the things in leverage finance. There are companies that very clearly deserve to take leverage that is above what banks are allowed to do, and private credit fills that gap and is able to allow sponsors and companies to operate at higher leverage multiples than would be allowed. And so in the middle is everything else, and so that synergy works out. Who it mostly benefits is companies looking to raise capital. They have a lot of different markets to go to. They have a lot of opportunities between higher cost and more flexibility, or lower cost and increased scrutiny and covenants. And so that opportunity set for clients is primarily the main beneficiary. And banks are also helped out by it. We talk a bit about this. Your point is spot on. Like the banking sector alone, given capital constraints, can't fund the global growth around some of these massive infrastructure projects and things that are going to be needed to move us forward. So that partnership and access to capital is critical for all of us.
Right. So maybe keeping on that, from a client perspective, what are you seeing? Are your clients pulling back on leverage? Are they still finding ways to fund growth through alternative channels? But how are they thinking about capital right now?
It's a great question, and it's very sector dependent, right? So if we start in leverage finance in particular, almost everybody's impacted somewhere through the value chain with tariffs, right, and the supply chain. And so, but there are still some sectors, like if you think about the software sector, which tends to be domestic, service-based, those companies can handle a lot more leverage, and they're looking to do that. Obviously, our private equity sponsors, when they buy companies, maximize the amount of leverage they can put onto it based on whatever their financial model is. But certainly on the corporate side, we are seeing, people being a little bit hesitant. We are now seeing, the main way to look at this, and other than just what happens in the credit capital markets, is confidence that companies have in doing M&A activity and whether they're going to use debt to finance that or do it mostly through equity. And so we are seeing a little bit more of a resurgence in M&A over the last few quarters, which is good for the overall, health of both credit markets and, and equity markets, which is showing a bit of a confidence coming back for them. But not all of those are watching companies get massively levered. Investment grade companies tend to be very focused on maintaining their investment grade rating and the access to capital that provides. And we have not seen that many companies lever up so that they're going into different markets. So it's very, very sector dependent. It's also dependent between you're talking about leverage finance or investment grade. It's kind of all over the map.
Great, thank you. So Joseph, you and I are both working for UK-based asset managers. And so to maybe take a European lens on things, how do European central bank policy signals compare to the Bank of England or the US Fed, and how do they shape credit exposure decisions?
I think if you look at effectively the key indicators of those banks has been the level of rates. If you look at ECB to start with, I think they've decreased 7 times the rates over the past 12 months. UK has done a couple of decreases recently. And the level of inflation is also key. At the end of the day, inflation is also a key indicator of how much, how costly a credit can be ultimately to finance the growth of the economy. Comparing UK, Europe, or the US, actually IMF published a report yesterday on the UK economy, showing that it was the second most growing economy this year for once, behind the US. Yet at, I think, 1.3%, US is above 2%, yet inflation is very high, close to 4% probably this year, and they have to fight inflation, which means cost of credit is still high, rates are very high, around 4%, which is less the case in Europe at 2.25%, because they've been managing the level of inflation quite well at 2%. So it does affect the way business is done, the level of, let's say, credit activities around these various geographies. Yet, for sure, we've seen the resurgence of private credit, and as you rightly said, despite the lower level of M&A activity, we know that whenever we have a higher level of M&A activity, we need equity and we need private credit, direct lending, what we call sponsored direct lending. That activity is slightly, taking up again, which means that a higher level of private credit activities in the world.
Great, thank you. So Kevin, from a North American perspective, North American banking standpoint, how has the current environment changed any underwriting disciplines you might have or credit appetite? Has it changed it or evolved at all?
I would say a little bit. I mean, there's an old adage in our business, which is the best loans are made in the worst markets, right? And so when you're dealing with a company that is going through some difficulties, obviously the cost of capital that you earn is better. And that's clearly not the market we're in right now, right? Over the last year or so, we've seen spreads, the risk premium over treasuries that you receive for corporate credit, collapse. They're at the tightest they've ever been for both high yield and for investment grade. And so we are very bullish on kind of the economy and general position of corporates in North America. There is so much demand for capital that it's pushed down borrowing costs. And so as an originator of debt to sell to institutional investors, and I'm sure you have a view on this as well, is, are people getting adequately compensated for the risk that they're taking? So when you break the credit appetite into its 2 pieces, one, do you think the credit is good and sound and you're going to get your money back? We feel pretty good about that. And companies have, have either worked through what they think their model is going to be going forward based on tariffs or geopolitical instances, et cetera. But the cost that they're, or the interest that we're receiving, both as a banker as institutional investors, is at kind of an all-time tight. So we really try to measure those two and balance those two. So I would say, it's pretty clear from the activity that's occurred after a couple of years over the last few years, which has been pretty low on corporate credit issuance, given the overall environment and rate environment we're in. We are seeing a lot of companies come back to the market to raise capital, and we're balancing both the credit opportunities, which we think are pretty good, and the cost of capital that we have to earn a premium over, which is under pressure. And so, those two things go together, and we're still very, very active, but you have to really pick your credit and the client correctly across the spectrum.
Yeah, I'd love to echo what has been said. Effectively, the spread have tightened a lot over the past 18 months. That's the characteristic of the market, driven, as you said, probably by the fact that we have an imbalance between supply and demand. Everybody wants to buy those papers. And indeed, it made it even more competitive. Two, we've seen other alternative scenarios or alternative ways of financing companies through the broadly syndicated loans. That market has increased again. So that's provide effectively other options for borrowers and lenders, actually. So indeed, we've seen that credit tightening. And as you said, for, let's say, market players like you or us, it's all about quality of credit, where you want to put your money at work ultimately.
You use that term quality of credit, and I think that's important. I think we've seen, over the cycles, and I think when people hear the term private credit, we do have to demystify private credit to a degree, but I also think transparency in the private credit and understanding what private credit is important, because we don't want, any more blow-ups that can kind of taint the whole, market or industry in that. So do you think that private, and this is to both of you, I'd love both of your perspectives, has private credit become a stabilizer to the system, or is it a potential source of systemic risk?
Happy to start. So I have to say that since the GFC in 2008, we've been under a big trauma in the whole industry, in the whole economy actually. And every time we see a sector growing, probably too fast, we always have this syndrome of, are we going to go again under a massive systemic risk? Today, private credit is exactly spot on for a number of reasons. It's been growing very fast. It's illiquid to some extent. Questions on valuation practices are on the table, and transparency of valuations are there. This is why regulators are looking into it actively. They're happy with what operators are doing, but they would love to see more transparency on valuations and other mechanisms of liquidity to be provided to the market through secondaries, for example. I think it's the Fed who published a report earlier this year saying that they don't see any systemic risk on private credit. So we need to look at the glass half full, yet we probably need to tighten regulatory framework to make sure that while this market is growing very fast, estimated size today I think is $1.6 to $1.7 trillion worldwide, expected to reach $3 trillion by the end of the decade, which is huge. So we would rather protect it by not over-regulating it as Europeans tend to do, but to strike the right balance in that space.
I would love to disagree with you at some point in this panel, and maybe we'll get to it, but this isn't going to be the one. So when you think about systemic risk, the question is which system, right? And so global financial crisis and the regulation that went in, particularly around leveraged finance, was to make sure the bank's balance sheets were stable. And since then, you brought up, there's been increased capital requirements. So from that perspective, having all of this credit distributed into the system with investors that are actually paid and compensated to make investment decisions and hold it, stabilizes the banking system. The question is, where are those investors going into it? So some of the questions that are coming up now around private credit, which has historically been an institutional investor as an LP, so pension, sovereign wealth funds, other large money managers going into it, who are also theoretically and supposed to be, very sophisticated around the risks in the asset class. As that moves a little bit more into some more retail strategies, I think that creates, some questions as to what the repercussions are going to be. The other thing that has not yet been determined out of this is, what happens when some of these companies go into financial distress and they have issues. Historically, in a distributed market where we've sold it to institutional investors, you might have 50, 100 investors in some particular deal. In private credit, it's much more concentrated. And so one of the ways that a lot of people work through bankruptcies is they just sell the paper and, get it into somebody else's hands. And so, what that means for how companies move through financial distress and get some accommodations from their lenders, or potentially go into bankruptcy, either here in North America or in Europe, which have different programs and policies, and how that works through. Like, we don't actually have an answer for that yet, and so that to me is one of the things that will be the big question if we do get into another credit cycle. How do these companies actually emerge and continue to be going concerns for their employees and their communities?
Great, thank you both. Let's shift gear to innovation. I've got a question for each of you. So, Kevin, in North America, are you seeing any structural innovations that improve access to capital or better share the risk between banks and investors?
Yeah, there's, going back to one of your early points, we have two private credit JVs, right, where we actually have an SMA with a private credit fund. They want to own the asset and we want the client relationship, right? So there are clients that do private credit deals that still need to do cash management, and they still need some treasury services. They need to hedge their currency or commodity or interest rate risk, et cetera. And so we really want to have those clients. And when we talk about losing business to private credit, a lot of times it's not so much the origination of the loan, it's everything that comes after that. So there's been a ton of these that have been talked about. We have two of them that have been in place since 2021. A lot has been talked about these strategic risk or synthetic risk transfer agreements, whereby we sell assets off our balance sheet to an institutional investor who gets a little bit of leverage on it, and the banks get real capital relief on that and a pretty acceptable cost of capital. And this is also what would be considered private credit from the institutional side. They get a big chunk of assets in a reasonable structure. And so so there's been a number of these things. So many of the large private credit asset managers out there have approached us to do things like, can we just do forward flow agreements, right? Which is, if you're originating commercial real estate mortgages in a regular flow and you don't want to own all of it, can we just get in part of that, right? And so there is this partnership, again, which is, I think, healthy, which is there are asset managers who understand assets and want to own assets for their investors, and then there are banks who have massive origination capabilities. And so partnering those two things together is going to be, I think, very good for both the banks in terms of their regulatory capital, and for asset managers getting access to good investment ideas at a pretty low cost for them.
Great. And so then, Joseph, you've spoken in the past about innovation in the European markets, and particularly with respect to sustainable infrastructure and transition finance. So how is credit capital supporting the green transition, digital transformation, and even industrial renewal in Europe?
Happy to answer, but just reacting to what you said before, partnerships is key these days between asset managers and banks. As you rightly said, I think your model is what you call the originate to distribute. You cannot hold all the paper into your balance sheet, and we are happy to help you to take part of it in our, and distribute it as well. Then we also speak to the rest of the ecosystem, the long-term investors, sovereign funds, insurance companies, that are happy actually to also hold that paper. And that's how the whole ecosystem has developed itself. And effectively, it's been quite great innovative, let's say, ideas around it over the past years. One number I'd love to share is, if you look at who lend money versus what it was in the past, banks used to lend money everywhere. I think today in the US, it's 75% of loans are done by, through private markets. 25% are still in the hand of banks. Whereas in Europe, it's probably the opposite. It's the reverse. Banks still play a key role in the economy, and they are under the strong and same type of pressures that the Americans are. And we know that the roles of private market, private credit will be increasing over the next years. So it can only grow, and Asia is at its infancy. So whatever happened in the US, where you led the way actually, is happening more and more in Europe and will happen in Asia as well. And it will bring more ideas, more innovation behind. Back to your point on the topic of transition, but also AI and eventually actually even defense, not only supporting industrial sectors. First and foremost, we've seen what the Ukraine-Russian war brought and how Europe was too much energy dependent on Russia and is looking for its energy independence. That's why Europe is very keen on sustainability and on energy transition in particular. We need to acquire in Europe our energy independence that I think you have here in North America. And it requires more investment into energy transition, indeed, both in the form of equity, but also debt. And clearly, infra debt is the category where we see a lot of demand out there and effectively to support that investment. It's true as well in AI, more and more requests coming from companies in the form of digital requests, I mean from clients, so on and so forth. So those sectors are growing and the support of sponsored or non-sponsored private debt will be critical to support that growth.
Okay, the three of us determined backstage, thank you, Joseph, for answering that, backstage that when we're followed by someone with a title of His Excellency, we're going to stick to the time frame. So we're going to finish on a bit of a lighter note and a telling note. And so I'm going to ask each of our panelists today if they could describe the global credit market in one word today, and then one word for where it's headed. Kevin.
This would have been good to have in advance. Currently today, I think dynamic is the right term. I mean, it's a little cliche, but everything we just talked about, there's a multitude of different structures, a multitude of different investors. If you're a client going out, you're like, I can do a covenanted bank deal, I can do a covenant light deal, I can maybe go upscale and do something off balance sheet in a structured deal. There's so many opportunities for corporate leadership to think about. And then, with that comes, the evolution of very smart people in all parts of the world trying to figure out how to take advantage of that and feed that need that companies have for capital. So I feel very, very good about, the dynamism that's going on in the marketplace, being solution oriented. And then going forward is, continually uncertain. I mean, that's the basis of financial markets. And I don't have I'm glad the question was what keeps you up at night, because normally whatever kept me up at night in history never happened and something completely out of the blue happened, the old black swan concept. And so, there's clearly a lot going on around the world geopolitically, economically, and with trade wars and all sorts of other things. And so there's always questions of what happens next. So, I say uncertain, but I don't necessarily want to put the negative connotation on the word uncertain. That's the risk premium that I think people can get paid for if they manage it correctly.
Right. Same for you, Joseph.
Yeah, when I look at it, at the private credit market today, I would say promising. It's been growing very fast and will keep growing for all the reasons we explained before. We will see even more growth coming in Europe and eventually in Asia as that market will develop itself. And by the way, if you were to look at the top 20 economies in the world and the correlation between the private credit growth market and GDP growth is pretty high. So as long as the economy is growing, it's the proof that it is a tool to finance the growth of the economy, ultimately. If I project myself in the future, I would say private credit becoming mainstream. We will see it everywhere. And I know we don't like it at this part of the world. It's something we do a lot in Europe, is to regulate, sometimes too much. But if we want to protect that market, we need to make sure that the rules of engagements are well understood, transparent enough, if we want ultimately what we call the democratization of private market or private credit, where you're alluded to. If we want the end customers to invest into it, we need to make sure the rules are extremely clear for them. So we're going to have to regulate a bit more that market, especially if it's becoming as big as what experts expect it to be.
Well, wonderful. So if there's one takeaway from today's discussion, it's that credit and capital ebb and flow with the cycle, but confidence really is built through discipline, innovation, and perspective, all of which I think we've heard very well from both of you. So thank you very much. Please join me in thanking our panelists for their insight. Thank you.